А это кто монтаж будет делать? Арспик. Бардруспа. Перезаписывать не придется? Проверка, проверка. Запись пошла. Все, Рахмет. Hello and welcome to the lecture 4, which is about understanding credit and loans. So in this lecture, we will cover the fundamentals of credit, types of loans, how credit scores work, and the consequences of managing or mismanaging credit. So the focus will be on practical tips for building a good credit score and understanding different loan structures. And it will be provided with detailed examples that you will understand better in real-life situations. So what is credit? And how credit works? Yes, so you're borrowing money now and paying it back later. So, and in order to understand credit, you need to know these concepts such as principal, interest, and repayment terms. Why is it important for us? Because credit is essential for major purchases such as homes, cars, getting good education. It affects loan approval, interest rates, and rental agreements. And employers and landlords may check your credit score. So credit versus debit. So your credit card, you're borrowing from the bank, so you're getting a loan and you pay later with interest. Your debit card, using your own money, deducted from your account immediately. So using a debit card for daily expenses versus using a credit card for a large purchase such as home or car. So there are two main types of credit that we will cover today. Revolving credit, which are credit cards, lines of credit. You can borrow up to a limit, repay and borrow again. And then installment credit, fixed loan amounts paid back over time, yes, such as mortgages and auto loans. So Manshuk, she has a credit card with a 2,000 limit. She spends 500 and pays it off at the end of the month. She can continue using the card as long as she stays under the limit of $2,000. Serik takes out 10,000 car loan with a 5% interest rate to be paid back over 3 years in fixed monthly payments. So he cannot borrow more on this loan. So how credit cards work? There are minimum payments versus full balance payments. So you need to understand interest rates and grace periods and late payment fees and penalties. So usually when you are signing a contract with a bank, you need to read the whole contract, especially the fine print, where you can find all these conditions on interest rates, grace periods, and late payment fees and penalties. Yeah, because in life we can encounter in various situations, and it's better to be prepared financially. So how do we use a credit card? So Saulé buys a 1,000 laptop on her credit card with a 20% APR. If she only pays the minimum each month, it will take years to pay off the balance, and she will end up paying much more than 1,000. Yes, because the interest rate is quite high. Okay, so in this case, you might think about finding a better bank with a lower annual percentage rate. So let's continue with understanding interest rates. So you need to understand APR, which is annual percentage rate. This is the yearly interest charged on borrowed money. And you need to think in terms of simple versus compound interest. So, for example, you carry a 500 balance on a credit card with a 15% APR, and your interest is compounded monthly. After 1 month, the interest charged will be approximately $6.25. Now let's continue with different types of loans. So in this lecture, we will look at secured loans and unsecured loans. So secured loans usually backed by collateral. So if you're buying a house, you will have a mortgage where the collateral will be your house that you are buying. Then auto loans, yes, where the collateral will be your car. And unsecured loans, no collateral required. So these are personal loans, student loans. So, for example, you are taking 200,000 mortgage to buy a home, and the home serves as collateral, meaning if you fail to repay the loan, the bank can take your home. In terms of unsecured loans, you borrow 10,000 with no collateral to pay for your college or university tuition. Since the loan is unsecured, the lender relies on your credit worthiness to approve the loan. That's why you should be careful with unsecured loans. So, and when we are dealing with loans, you want to understand principal. So this is the amount of money borrowed. Interest, the cost of borrowing money from the bank or other financial institutions. Term, the length of time to repay the loan. And amortization, the process of paying off a loan in regular installments. So now let's take a look at the example. So you have a 20,000 car loan at a 4% interest rate with a 5-year term, requires fixed monthly payments. And each payment is part interest and part principal, and early payments mostly cover interest. Yes, and by knowing all these concepts, you can better understand the contractual agreements when you are signing a contract with the bank. Now let's take a look at credit score. So credit score ranges. Excellent is 800 plus, good is in the range of 700, 799, fair is 650 and 699, and poor is 600 and 649, and bad credit score is lower than 600. Yes, so your credit scores are based on payment history, credit utilization, length of credit history, and types of credit. So when you are paying credit, you should not miss the payment period. Otherwise, it will worsen your credit score. So why credit scores matter? High credit scores mean that you can borrow at lower interest rates, and it affects approval for loans, credit cards, and sometimes rental applications or jobs. That's why you want to have a good high credit score. So how they are calculated? So the bank will look at 35% payment history. Yes, are you paying your payments on time? 30% credit utilization, amount of available credit used. 15% length of credit history. 10% types of credit used. and 10% recent credit inquiries. And here is an example. So Sambat has 2 credit cards. One has 1,000 limit and she carries a 300 balance. The other has a 5,000 limit and she carries a 1,000 balance. So her credit utilization is calculated as 300 plus 1,000 divided by 1,000 plus 5,000, which is 21.7% is credit utilization. So how can you build a good credit? So you should pay your bills on time, keep credit utilization low, avoid applying for too much new credit at once, and keep all the accounts open to maintain credit history lengths. And nowadays all these processes are automated, and the bank will do it kind of in short period of time to calculate your credit score. So building credit from scratch. So Zhebek gets her first credit card with a 500 limit. So she uses it to pay for groceries and gas, never spends more than 100 each month, and always pays the full balance on time. After 6 months, her credit score is 720. Yeah, that's why people are not using only debit cards, but also credit cards, so that they can build their credit score. So the consequences of bad credit. Yes, so you will get high interest rates on loans and credit cards. You will have difficulty getting approved for loans or rentals. And then risk of being denied employment for jobs that check credit reports. Yes, so that's why you need to think in advance about your credit score. So Bolat misses several credit card payments and maxed out his credit limit. When he applied for a car loan, the interest rate offered was 18% because of his low credit score. So if you have low credit score, it means you are more risky. You have high risk of not paying back. And in this case, he was offered 18% compared to 5% for someone with good credit. So, and when we're talking about credit scores, usually banks look at credit reports, which are detailed records of credit history. And here are the 3 major credit bureaus for US. And for each country, there is own credit bureau. So in Kazakhstan, it's First Credit Bureau, where the banks take the information, or you can also request the information about your credit score. Everyone is entitled to 1 free report per year from each bureau. Yes, so depending on the bureau, you need to look at the conditions. So usually 1 free report per year is okay, but if you need more, you have to pay for it. So Aaron requests his credit report from Equifax and sees an error when all debt is still showing us that it is unpaid, even though he paid it off years ago. And he disputes the error and it is corrected. Yeah. But usually it's kind of more or less correct, but periodically you need to check your credit report. So let's continue with loans and interest rates. We have fixed rate loans. Interest rate stays the same throughout the loan term, and variable rate loans, interest rate can change over time depending on market conditions. Yes. Usually you are dealing with fixed rate loans, but as you are getting more financially savvy, you may encounter with variable rate loans. So Sulu takes out a 15,000 loan. She's offered a choice between a fixed 5% rate or a variable rate that starts at 3.5%. If she chooses the fixed rate, her payment stays the same. If she chooses the variable rate, her payments might increase if interest rates go up. Yeah, so, and you need to think which is more advantageous to you in this position. Yeah, so if you want more kind of stability to plan ahead, then you might take a fixed rate. And if you think that the interest rates will go down in the nearest future, then it might make sense to take a variable rate. But usually it's easier to take a fixed rate. There is more prediction and easier planning will be involved. So how would we manage our loans effectively? So you want to pay more than the minimum when possible to reduce interest costs, avoid borrowing more than you can comfortably repay, consolidate high interest debts if necessary. And the conclusion for today's lecture is that credit and loans are essential tools when managed wisely. Building and maintaining a good credit score opens you opportunities, and you should understand loan terms and interest rates before borrowing, and that's why we covered all these different concepts and illustrated them with examples. Thank you for your attention, and this is the end of lecture 4. Все? Ахмед.